Well, welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host for the day, Dane Moeller of Primary Residential Mortgage. Mark Hanf and Nam Phan are off today. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. And that certificate is not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is miscellaneous trivia. So Dane, you've been on the show a couple of times. Welcome back. Great to have you.
Yeah, happy to be back. Thank you very much.
Good. All right. So you are quite the extraordinaire mortgage broker. Are you actually the broker of record of a primary residential mortgage? Or
No, I'm certainly not. Primary Residential is a pretty large company. They did $12 billion in lending last year. I'm a division president here in the Bay Area, and we are a direct lender. So we do broker, but mainly we are the one lending the funds.
Gotcha. I mean, I knew you were El Presidente, but I wasn't sure if it was okay.
Just of this area division, Ken Knudsen in Salt Lake City is the CEO, and he's the head boss.
Okay. All right. So let's start off. Tell us what's going on in the residential mortgage market, because everyone's talking about rates going up.
Yeah, they've been going up and going up quickly. You know, it has been the outlook for quite some time that rates would increase. If you'd asked me on the first day of the year when we would get to 4%, I probably would have said, fourth quarter, maybe third quarter, and we're there now.
Wow.
Interest rates have gone up over 1% since December 1st. So in 60 plus days, we've seen an over 1% increase.
Okay, but that's not exactly correlated with the prime rate, right? Because have they even changed the prime rate yet?
No, the prime rate hasn't changed. So the Fed, which controls the federal funds rate, which prime is tied to, right? Prime is 3% above the federal funds rate. That's at the very shortest end of the interest rate spectrum, right? That's the overnight borrowing rate. That's where banks borrow from the government tonight to tomorrow, right? So shortest thing you can get, just overnight. Yeah. Mortgages, very long term, right? We're talking 30 years, maybe 15, maybe 20. So it's a very other end of the lending and borrowing spectrum. So the Fed doesn't control that. Now, that being said, just like the stock market reacts to what the Fed is going to do or what they do, mortgage rates do as well, right? So nothing exists in a vacuum. And the Fed indicating and promising they will raise rates, the mortgage market is getting ahead of that, just like the stock market's having all kinds of ups and downs as they come to terms with, what do these changes mean for borrowing costs for businesses and for our economy as a whole.
Yeah, so as an example, today, we're actually recording this on Thursday the 10th. It'll air on Saturday the 12th. And just today, the market was down over 500 points. So probably in anticipation of those rates going up.
Yeah, and the 10-year Treasury broke through the 2% barrier today, which it hasn't been above, I think, since 2018, maybe 2019.
2.031, yeah.
Yeah, so 2.04 is a pretty important line now, and if we cross that, which it may happen while we're on this call, 2.1 is the next logical stopping point. And so, whenever you borrow on a mortgage, right, there's the other side of the equation. There's the person lending the money who's earning the return, right? Yep. They actually generally buy what are called mortgage-backed securities, which is what Fannie Mae and Freddie Mac produce and sell on the market from the mortgages that are created, right? Those kind of investors are comparing the risk of treasury bonds to mortgage investments. And if treasury bonds are at 2.1, well, you got to guess they're not buying mortgages at the same rate. So as treasury bonds rise, mortgage rates got to be above that to attract investment. So that's why when you see treasuries go up, mortgage rates will generally also be going up. It's not 1-to-1, but it's a pretty sure bet that if you see the 10-year Treasury going up, mortgage rates are up. Or if you see the 10-year Treasury falling, mortgage rates are going down.
Well, it's interesting. In the old days, hard money loans would generally be 5% above prime. And then, or actually it was more, whatever you could get a normal bank loan for, roughly 5% more. And then as competition came in for hard money loans, that went all the way down to about a 3% spread. So it's kind of the same way where, you kind of look at it's sort of the risk, but there's also the supply and demand issue. Okay.
Yeah, there's going to be a lot of more competition by mortgage banks out there for everybody's business. Last few years, mortgage industry has added a lot of employees who now all still want to keep their jobs. So the mortgage banks are going to be competing, but the underlying market going up, there's only so low they can go because everybody still has to sell those loans or hold them in their portfolio, and they got to compete with other asset classes.
Yeah, everything's based on alternatives. And if you can get a, quote, risk-free return from the government as treasury bonds are going up, I could see that you'd have to raise the interest rates on the mortgage-backed securities to attract investors.
Yeah, absolutely.
Yeah, and so what generally is that spread difference?
So it's a good question. So mortgage-backed security prices aren't what a consumer would get, but like the 3% coupon today, which is basically an average of 3% rate is the easiest way to say it, was selling at around 100. It actually a little bit less, and 100 means basically par, right? No premium on that. So if you figure that's at about 3, and then 10-year treasury is about 2.1, you're talking about. And these are really rough numbers, but about a 1% spread.
Gotcha.
I'd say.
Okay.
And that spread changes over time as risk in the housing market changes, right? When people feel very secure about the housing market and the security of homes, when they're going up in value so quickly, right? And the security is great. Well, then that spread will come down. And right now, the foreclosure rate in the country is the lowest, or almost the lowest it's ever been. So, very secure investments and houses are going up in value. But if that changes, the spread will increase.
Very good. Okay, we're going to cut to our first commercial break. And again, if you know the answer, Dane, wait till we get back from our commercial break. First trivia question is, what TV show began with the words, "There's nothing wrong with your television set"? This is probably before your time. Call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. Stay with us. You are listening to The Best of Investing. Don't touch that dial. We are going to be right back. Welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with my special guest co-host, Dane Moeller of Primary Residential Mortgage. First trivia question. What TV show began with the words, "There's nothing wrong with your television set"?
I mean, I would guess Twilight Zone, but that's probably not it.
You know what? That's pretty close, though. There was a time in the 60s when there were a whole bunch of shows like that. One Step Beyond. This one happened to be The Outer Limits.
Okay.
Which was also kind of creepy.
Twilight Zone, that sounds like a start, but Outer Limits, I'll have to brush up on my 60s TV for that one.
All right. Hey, I want to make a quick mention here for Polio Restaurant, which has been the premier Italian restaurant serving downtown San Francisco since 1990. They've been in business, obviously, over 30 years. They went through a recent remodel, complete remodel recently. And it's no wonder that that it's been voted one of the best restaurants in San Francisco by San Francisco locals. So visit poliosf.com and view their menus and make a reservation today. All right, so Dane, we're talking, about interest rates. Generally, right now, today, I know there's conforming, then there's jumbo, and there's 15, and there's 30. Can you go through the gambit with us?
In terms of generally where things are standing these days? Yeah. So you're looking for kind of, let's say, a perfect scenario, higher 3% on the 30-year fix, approaching 4, 15-year fix, mid 3%. Jumbo loans, if you have a great scenario, you can do better than conforming. So you can still be like mid 3s on a 30-year fixed and a little bit lower.
I'm going to guess that has to do with if the loan to value is really
loan to value, great credit score, lots of assets, meeting debt to income requirements. The jumbo does a little bit better job of rewarding somebody that has a really great position. Where conforming loans, they just say, hey, if you meet the minimums, here's your thing. Outside of credit score, loan to value.
Yeah. So on a 15-year jumbo, what are we looking at?
like low threes,
Low
three and a
threes.
quarter, I'd say is probably pretty average right now.
And the 30-year jumbo?
3.5. It's not
Yeah.
that big a
Yeah,
spread.
I know it's funny. In the old days, it used to be at least a half a point difference between 15 and 30.
It's the spread has come down, and that's natural as you start to approach zero. That'll happen. As rates compress, there can be only so much difference.
Yeah.
And it's interesting to think about why it would make sense to do a shorter term. Often we say that in order to do a shorter term, you need to get a lower interest rate because you're giving up flexibility, right? You can always pay off longer loan faster, but you can't, on your 15-year fix, you can't say, hey, this month I want that 30-year payment. Right?
Yeah. Exactly.
So you have to think, what is that flexibility worth to you? And then in return, how much less are you being charged from the bank? How much lower an interest rate? And for 0.25%, unless the payment's really low, I don't think it's worth giving up that flexibility. So
I would agree. Yeah, for a 0.25%, I would just take the 30-year and just, if I have extra principal that month, just pay it down.
Yeah,
because you can turn it into a 15-year by making those extra payments.
Sure, and you never know. If you want to buy another property and turn that into a rental, and then you're real happy you have a 3.5% 30-year fixed, right, instead of a 15, or who knows. So you leave your options open with the longer term. But if you are getting 0.75% difference, well then, hey, that's big.
Yeah, that's huge. We're going to mention this a couple of times, but how do people get a hold of you if they have questions for residential mortgages?
So easiest way is either call or email. I'm here in San Rafael, California. So phone number is 415-870-2752, or you can always email me at D as in David, M as in Mary, OLER at PrimeRes, that's PRIMERES as in Sam.com.
Okay, and you guys are actually mortgage bankers, right?
Correct. Yeah, so we are mortgage lenders. We're a direct lender. Everything we do is in-house in terms of underwriting, processing, funding, servicing. We keep everything within our small group, which lets us get things in quickly, meet quick deadlines, quick turn times. Our underwriting right now, if we submit in the morning, we have an approval in the afternoon. So
wow. Okay.
Nice.
And what's the fastest that if somebody gives you a complete file that you can actually?
The fastest we can close is generally very dependent on the appraisal turn time,
Yes.
because that's still the bottleneck on most deals. But sometimes we have appraisal waivers, and now Fannie Mae and Freddie Mac are actually allowing desktop appraisals in a lot of purchases. So without an appraisal roadblock, we can close in 11 or 12 days.
That's really fast. Yeah, yeah. And then if I remember what you said at the beginning, though, was that sometimes you can also broker deals so that someone comes to you, and if for some reason it doesn't fit into your criteria, you can still get them the loan.
Absolutely.
Just outside, which is really good, because then you can kind of be a one-stop shop. That's sort of that independent broker. If you guys have the best deal, boom, get it. If not, or if there's some kind of glitch, you can just turn them on somewhere else.
Yeah, absolutely. And we are seeing a big uptick in the investor debt service coverage ratio loans. So those are loans that only look at the investment property and don't look at personal tax returns or personal income. So for people that have purchased homes with somebody like yourself and are looking for a longer term lower rate, the debt service coverage ratio is great. We can also qualify self-employed income using bank statements through our broker. So for people that may have real strong revenue coming in, but their tax returns, they may have a few write-offs on there. That bank statement qualification is a great alternative way to qualify income, and we do that through our broker channels.
Yeah, that's really a powerful tool, because going to a typical big bank, they're going to scrutinize everything and tax returns, and you look through your checkbook and, well, why did you spend $100 over here? Explain this to us. It sounds like you guys obviously do underwriting, but you have some flexibility.
We try to be as make sense as possible. We're a full service, we like to say Nordstrom style lender versus a big bank where you're just going on the conveyor belt. They're sending you to a processing center in another state, and if they do your loan or not, it doesn't change their day.
Gotcha. Tell you what, we're going to go to our second trivia question, but it goes kind of fast, Here's our second trivia question here. What is the name of Stephen Hawking's Cosmology book published in 1988? I don't know how many other books he's written, but this is like his famous book that everyone seems to referred to. Call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. What is the name of Stephen Hawking's Cosmology book published in 1988? Stay with us. Best of Investing. I'll be right back. Welcome back to the Best of Investing. One more time, I'm Edward Brown, your host, along with my special guest co-host, Dane Moeller of Primary Residential Mortgage. Second trivia question, what is the name of Stephen Hawking's Cosmology book? I always want to say cosmetology, but that's different. Cosmology book published in 1988. What was the name of that book?
That one I do know. A Brief History of Time.
A Brief History in Time. That's the answer. Very good. Also, I want to make a mention here for this sponsor we have called Catch Some Relief. And it's kind of funny because they actually have this pain medication. Originally, it was designed for fishermen, but then they realized people other than fishermen have bad backs and stuff like that. And they actually sent me some of their products, and it actually kind of works. I was pleasantly surprised. It's like, you know how like, sort of like Ben Gay, it's that sort of thing, but doesn't have that smell. And it works pretty well. So check them out. You can just Google catchsomerelief.com and you'll find them. All right, Dane, an email comes in that's kind of right up your alley here. It says, if I lock in a rate and rates go down before I close my loan, can I get that lower rate?
Yeah, it's a really good and typical question. We get it quite often. So when you lock a rate, it's like a verbal handshake with a lender that's the interest rate you're going to close at, assuming nothing changes with the characteristics of the loan. Your loan to value doesn't change, your credit score, something like that. Okay. If rates go up, obviously the bank's not going to come back to you and say, hey, here's this higher rate because you locked it, right?
Yeah.
And the idea is if rates go down, you're going to do the same. In practice, however, lenders don't want to lose all of their locked loans if rates fall. Right? And they know consumers have choices and they could start over somewhere else if rates go down a significant amount. Yeah. So most lenders, ourselves included, have what's called a renegotiation policy, also known as a float down policy. And if rates change by a certain magnitude, we can go back in and move down to the lower rate. So generally by magnitude, you're thinking about 0.3% or more rate. So, I mean, it's a big change. 1/8%, let's say you lock 3.5 and it's 3.375. Generally, the bank's not going to float down in that circumstance.
That makes sense. I mean, most people too are going to go, do I want to start that process all over again for that little bit? So that totally makes sense.
Yeah. So, I mean, when you lock a rate, you should consider that, you're okay closing at that interest rate, right? Don't lock it if you don't want to buy it. But know that most lenders, ourselves included, if there's a big change in the market, we're going to do what we need to keep your business.
Gotcha. So you really don't need to pay that extra fee to lock in the rate. Except that if interest rates go up and you haven't locked it in.
Yeah, so we don't charge any sort of lock-in fees. So there is no fee to lock in the rate with us. And some lenders do, but it's industry most commonly there isn't a lock-in fee.
Okay.
And I'm a big fan of locking an interest rate as long as it fits the overall goals. You don't want to work at something and get an appraisal and submit paperwork, and then at the end of the process realize that the numbers have gone way up and you're not happy. And maybe you don't want to go through with it after all. Right?
Well, it almost sounds like it's a no-lose situation, because if it doesn't cost you anything to lock it in, but oh, by the way, if it's dropped enough, you're probably going to get it renegotiated anyway.
Yeah, and we can lock interest rates on day one, and we generally do. It's in our best interest and the consumer's best interest, especially right now since rates have been going up. Occasionally. Rates are moving down and you say, hey, let's watch them for a couple of days. Let's see if we can find a bottom. And there's usually kind of a identifiable wave pattern in how rates move in a normal market. Right now they're moving in one direction, but often they're kind of within a small band and kind of going up and down a little. And you can time it. We watch that every day. And I have multiple monitors, and one is just the MBS market. And for those things.
I mean, you have to kind of watch it hourly, probably, don't you?
It's just like a stock market or a cryptocurrency price, it's changing every second
Yeah.
in real time.
And that's kind of hard, kind of pinpoint exactly. I mean, obviously, it'd be difficult to get the low, but to realize, okay, I think now is a good time to lock this one in.
We spend a lot of money and time reading expert opinion and studying the market, and I've done this now for almost 20 years, and I've been looking at that chart for a long time. So after you spend 10,000 hours looking at the same chart, you start to see some things and feel some patterns. And yesterday was a day where I said, hey, we need to lock in, and we locked a lot of loans yesterday ahead of today's big red tape. So we saw
how much spread difference was there?
The MBS market lost almost 100 basis points today.
That's a point. That's a lot.
And that's to the price, not the rate. Rates didn't go up a point.
Yeah. That's right.
But that equates to an eighth or a 1/4%. 100 basis.
Gotcha. But that is still pretty. You usually don't even lose 100 basis points in a day.
No, an average day is 10, 15 in one direction or another. So this is a big day, and unfortunately not the way that anyone would have hoped for.
Wow. Well, I can't say enough good things about you guys, because we've actually worked together pretty well the last few years, where it's been pretty symbiotic, because I've had clients come and need a normal bank loan, which is right up your guys' alley, and the personal service you guys do. The clients have come back and said, thank you very much for referring these guys. They did me a good job, with the rate and the service. I appreciate that. And then on the flip side, there's been times when maybe someone's credit score was just a little bit lower than you guys could work with, and so, or there's been some kind of weird glitch, and you've turned it on to me, and we've been able to work on this side of the equation. So I like this relationship, because first they come to you, and then if it doesn't work out, you send them to me, and I get the loan done, and then I send it right back to you, so that you can refinance them at a lower rate. So I like that. That works pretty well. Let's see. Give out your information one more time. We're going to cut to one more break.
Yeah, thanks so much. So my name is Dane Moeller at Primary Residential Mortgage here in San Rafael, and my phone number is 415-870-2752, and my email is dmoeller, D-M-O-L-E-R, at primres, P-R-I-M-E-R-E-S, as in Sam.com.
All right, here's our last trivia question, our next one. What was Richard M. Nixon's middle name? What does the M stand for? Call 888-912-1190. First caller with correct answers and win that tanning certificate. Stay with us. Best of Investing will be right back. Welcome back to the Best of Investing. Edward Brown here, along with Dane Moeller of Primary Residential Mortgage. Third trivia question. What was Richard M. Nixon's middle name? What does the M stand for?
As a kid who grew up watching The Simpsons, I know this is Milhouse.
Milhouse, yeah, that's right. Richard Milhouse. Hey, you were 2 for 3. Boy, that'll get you in the Hall of Fame.
Pretty good.
Okay, so now, Dane, ordinarily, I mean, obviously you're working with mortgages, but you obviously follow the real estate market. You want to give us an update?
Yeah, and we work with a lot of realtors. We work obviously with a lot of home buyers, and we're seeing what's happening with prices and with the market in general. And prices increased dramatically, as everyone knows, last year. And it's how long can they do that? And my prediction for 2022 is we will continue to see prices rise. I don't think we'll see them quite as much as last year, but there's a lot of barriers to supply out there, and those barriers aren't going away anytime soon. Higher interest rates are going to be another barrier for sellers, because they're going to have to move to a new loan, and if they have 2.5% and rates are at 4.5%, are they going to sell, right? So I think we're going to see all property taxes have already been a hindrance, because unless they're older, they can't transfer their property taxes, and if their house has gone up since they bought it 10, 15 years ago, that's a big change. Now we're going to have interest rate shock as part of that change. So I think that we're going to continue to see restrained supply, low inventory. Demand is still very strong. We've had a big cultural shift in the importance of home due to COVID and how much time everyone spent at home. And we still have we still have this big group of millennials that are reaching their early 30s, which is the prime buying years, and they're starting to really hit the market. So I think demand will stay strong, values will continue to rise. And a lot of people say, well, should I buy? I mean, it's crazy, these prices. I saw some statistics on rent increases. This past January was larger rent increases than the last 6 Januaries combined. It depends on where you look. Some people are saying 4% increase. I saw it as high as 18% increase annualized in rents.
Wow.
You know, if you own a home, once you get that mortgage, I mean, your tax and insurance might go up a little bit, but that payment, I mean, that's it, right? That's your payment for the next 30 years, let's say. Your rent, not the case. So even though prices have continued to increase, I still think it's a great time to buy, get in, lock in that housing expense. Because if we're going to get into an inflationary period these next number of years, rent is not going to be left out. And it's going to put a big squeeze on people that.
I mean, think about it. They're landlords. It's not that necessarily they're being greedy, but if inflation is going to hit, then the cost of repairs and roofs and plumbing and et cetera goes up, and they've got to pass that on to some degree to the renters.
And it's supply and demand, and there's been a huge increase in rental properties owned by Wall Street. I mean, it's something like 25%, or all purchases are by big institutional firms, and it's not greed for them; it's just their business, and it's supply and demand, and they're going to charge what the market can bear. So and that ripples through the entire economy. And to your point, the landlord costs are going up too, right? So they got to cover them. So I do think, if you can get into a house, it can be intimidating to see pricing going up and rates going up, and it can be a complicated process. But we help people get into homes with very low down payments, challenging situations, and I've seen people that have come in with less than $10,000. I had lunch with a friend last week who we helped get into a house. He was out of pocket less than $10,000. He now has $100,000 in equity. So when I first sat down with him, he said, I can't buy a house. I don't have 20% down. And I said, you don't need 20% down. You don't even need 1% down. We can do it. And he bought a house up in Petaluma, and now has over 100,000 in equity from thinking.
How did he put down less than 1%? How could you guys do that kind of loan?
So we partner with some state programs, California. Cal HFA, California Housing Finance Authority, and also the Golden State Finance Authority. They do down payment and closing cost assistance as long as you meet certain requirements. And they'll cover a big portion of your down payment and a big portion of your closing costs. So, there are requirements, of course, but they will provide grants or second liens to help you get in the house, that as long as you can afford it and meet their requirements.
I'm wondering, I don't know if you know this, but I wonder what his rent compared to what his mortgage and taxes and insurance are, especially when you consider tax deductibility.
I know he moved up in cost monthly from his past rent, but what's that rent going to be in 3-5 years?
Sure.
That's what you got to look at. And he's got
$100,000 more of equity than he had.
And he's got equity, and he's got his first child in the way, and now he's even in a home he owns versus a condo he was renting, and could have received that 60-day notice at any time. You got a vacant because of X, right? No one can do that as long as you're paying your bills in your house that you own.
What you were mentioning about the millennials, my son is right in that ballpark. I mean, he just got married a few months ago, and he's tired of renting after so many years. And they're talking today about looking at a house to buy. I'd say they're out of state, but still, the theory is the same. And then also, it's possible that that Congress may change the SALT rules. The state and local taxes. They've been talking about that under the last administration. You can only write $10,000 off. And if they get rid of that, it'll make it a little bit more attractive for people who own homes with real estate taxes.
It really will. I got to say, I mean, it'd be a huge difference, and that SALT thing is such a huge penalty for California residents and homeowners, and it's an awful punishment to the coast of this country, so to speak. I will say that I didn't see as much effect as I thought I would. I think people look at housing on a more holistic level and run the numbers in a slightly different way. But I mean, it certainly makes a difference when I go to tax time.
It doesn't generally.
My property taxes, and they're above my SALT limit.
Yeah, and I was the same way. It angered me, but not to the point where it was going to change my life. It basically is just an extra tax that get gulp. I mean, because especially it's not just the real estate taxes; it's also whatever you paid in state income taxes. So a lot of people already hit that $10,000 limit there, so they weren't able to deduct any of the real estate taxes. So hopefully they'll change that rule pretty soon. Let's see, we've got 1 quick minute. We don't have another trivia question, but one more time, you got to give out your information.
All right. Well, thanks, Edward. So one more time, my name is Dane Moeller at Primary Residential Mortgage. You can reach me at 415-870-2752 or by email at dmoeller, DMOLER at PrimeRes, that's PRIMERES as in Sam.com.
Very good. And again, I can't say enough about your company and about you specifically, Dane, because I know that you and your company have done a very, very good job for the public out there, especially now. I didn't even know about this less than 1% deal. And you got to think that there's a lot of people out there who are wanting to buy a house and didn't think that they could because of the 10%, 20%, whatever percent down on that. So, okay, we're going to cut to our next, well, actually, there's no trivia question, but we're going to cut to a break. And when we come back, the Best of Investing will be right back with some closing comments. Don't touch that dial. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with my special guest, Dane Moeller. So in the private money sector, it's incredible because Pacific Private Money has been growing year over year. And I believe last year we did 330 million in loans.
330 million. Wow, congratulations.
Yeah, the expansion has been incredible because there's been a huge demand, for short-term money, to get to a point where guys like you can refinance them out. And we're kind of spreading the wings, so to speak. So we're getting lots of brokers online, but mostly, mortgage brokers, realtors, and that sort of thing. And again, kind of branching out to other states. In fact, I think the president had said of the company at Christmas time, he said he was not surprised to find out that it's very possible, you can't bank on this, but it's very possible that Pacific Private Money is the largest private lending company doing these owner-occupied consumer bridge loans. I know it's kind of a specialized thing, but it's a large market though. Because you have to have all the special licensing and all that. Yeah, so it's doing really well. So at Pacific Private Money, from the investor side, we have 4 different funds. Probably our most conservative fund is our Freedom Fund, where it acts very similar to a money market account. In that you put your money in, and as long as you give 30 days notice, you can get your money back after 30 days notice. No fee to get in, no fee to get out, and it just pays a straight 6%. And what are they doing with the money? Well, they're making these short-term loans and selling them to Wall Street. So about every 2 to 3 weeks, Wall Street writes a very large check back to the fund. So put it on the conveyor belt and do more loans. And that's kind of here's the downside, is it's a $250,000 minimum. So it's kind of a large barrier there. And then also you've got to be an accredited investor. So, net worth exclusive of your home of at least $1 million, or you make $200,000 a year if you're single, $300,000 if you're married. They also have their construction loan fund called the North Star Capital Fund. That fund pays 8%, has a 1-year hold with a target of 10%. And they've actually been hitting the target. So yeah, because a lot of construction going on in California. We also have the Southwest Fund, which pays a straight 7.5%. That one we're buying discounted loans primarily in Texas. And one of the specialties there is the fact that the loan to value is very, very low. So the average loan to value is about 44%. And since we're buying loans at a discount, it's under 30%. So that's a very, very conservative fund. It's only a $50,000 minimum, have to be an accredited investor, pays monthly. But now let me tell you the downside. The downside is because it's been so popular, there's been a fair amount of money pouring in. So if anybody invested today, I'd have to tell them, you know what, you're not going to earn 7.5% for at least a month, because we got to place that other money on a first come, first served basis. So your money could come in, but it's going to sit in the subscription account earning zero until we can place it. And that might be a month or so, but at least you hold your place in line. And interestingly enough, we've actually had a couple of people say, well, I'm earning 0% in the bank. I might as well keep my place in line with you. And it's like, okay, but just so you know, warning ahead of time, you know, next month, you're still going to get no interest, you know, but once it gets placed, then you continue to earn the 7.5%. And you just give us 30 days notice anytime you want your money back. So for more information, you can just email investor.relations@pacificprivatemoney.com. You can call me on my cell phone, 415-299-0330. I'm Edward Brown. I'm in the Investor Relations Department at Pacific Private Money. You can also go just check out the website, pacificprivatemoney.com. All right, you ready for our thoughts of the day, my friend? Here we go. Science is organized knowledge. Wisdom is organized life. And who said that was Immanuel Kant. And wasn't he a philosopher, if I'm not mistaken? Immanuel Kant. Why can't you trust people who do acupuncture? Because they're backstabbers. That's why. All right, tune in next week to The Best of Investing. We'll be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.